So now we're going to move on to the recording of stock when we issue stock. A share of capital stock can be issued at par or no par. There are some stocks that don't have a par value on their shares. The value of par stock is stated in the corporate charter and on each stock certificate. Remember we saw that one stock that had 25 bucks? A corporation cannot declare a dividend that would cause the stockholders' equity to fall below the legal capital. Remember, the legal capital is the par value times the number of shares that are authorized. Thus, par value is a minimum cushion of capital that protects a corporation's creditors. When a corporation issues par value stock, the appropriate capital stock account is credited for the par value regardless of whether the proceeds are more or less than the par value. No par stock doesn't have a par value. Usually states require that all or part of the proceeds from a corporation's issue of no par be designated as legal capital. Let's go through a problem. All that mumbo jumbo, let's kind of flush it. Rexio Corporation is authorized to issue 10,000 shares of $10 par value common stock. On January 1st, it issues 5,000 shares at $12 each. What are we going to do with the journal entry? Our cash is going to increase. We're going to increase our common stock, and we're going to increase something called additional paid-in capital. So basically, we sold the cash or issued the stock for 12 bucks each. 5,000 shares at 12 bucks each means our cash went up to $60,000. Okay? Now, the two credits, one credit will be 5,000 shares times the par value of 10 bucks a share, or $50,000. So we would have a common stock for $50,000 for common stock at par. The extra, the $10 extra, or the 5,000 shares times 2 bucks, that extra amount above and beyond the par value, gets put into something called additional paid-in capital. So as you see here, how it will show on the stockholders' equity section, contributed capital, common stock, $10 par, 10,000 authorized, 5,000 are issued. 5,000 times $10 is 50,000 here. But that extra money, that extra $2 a share, we go into paid-in capital, $2 times the 5,000 shares. So total contributed capital is $60,000. How will we show it on T accounts? What you see here is we debit our cash for $60,000. We credit under stockholders' equity common stock for $50,000 and additional paid-in capital for $10,000. See that? State law requires corporations to place a stated value on each share of stock. The stated value can be any value set by the board unless the state specifies a minimum. Here's an example. On January 1st of 2014, Rexio issues 5,000 shares of no par common stock at 15 bucks a share. So that's going to be $75,000. So cash goes up 75 and common stock is going to go up 75,000. Do you see here we don't have to separate common stock, par value, X amount, and additional paid-in capital? Do you see how it's all just going under common stock? Make sense? Because the stock doesn't have a stated or par value, Everything gets credited to common stock. Issuing no par stock with a stated value. Now assume the same facts as were provided previously, except Rexio puts a $10 stated value on each share of its no par stock. Again, our cash is going up the same amount. Our equity section is going up the same amount, but we're splitting it with common stock gets credited 5,000 shares times $10, that stated value. And then the difference, additional paid in capital, will be the $25,000. So stated value or par value, we're going to treat it the same way. So you see here the $50,000 gets put into common stock. The additional paid in capital of $25,000 gets put into above and beyond that stated value. A corporation could issue stock in return of assets. So instead of receiving cash, they're going to receive assets. Usually, these transactions involve an exchange of stock for land or buildings, or maybe the service of attorneys to get the stock going. So this kind of transaction gets recorded at the fair market value of whatever the stock is given up. If the stock's market value can't be determined, then the fair market value of the assets or services received. So Rexio was formed on January 1st, 2014. Its attorneys agreed to accept 200 shares of its $10 par value common stock for services rendered. At that time, the market value of the stock couldn't be determined. But for similar services of using attorneys, the attorney would have charged Rexio $3,000. So since the stock didn't have a trading value, the next best thing is knowing what was the service worth. $3,000. So we will show legal expenses get debited $3,000. Our common stock goes up 200 shares at $10 a share. And then that difference gets put into additional paid in capital, the extra $1,000. So basically, as you see here, $3,000 in legal expense, $2,000 goes into common stock, $1,000 goes into additional paid in capital. 2 years later, Rexio exchanged 500 shares of its $10 par value common stock for a piece of land. At that time, Rexio's stock was selling on the market for $16 a share. So that's how we're going to value the land, what the trading value is. So 500 shares at $16 a share is what we're going to value the land at. So the land is going to be debited $8,000. The common share stock is going to be 500 shares at $10 a share, and the difference goes into paid in capital. So you see here, land, common stock, and the additional paid in capital. So if you know the market value of the stock, that's what you're going to use first and foremost. But if you don't, then you're going to use what the value is of the services or what that land would sell for, adjacent land. Okay, so let's look at another problem, okay? Let's look at SE6. SE6 tells us Sigma Company is authorized to issue 100,000 shares of common stock. The company sold 5,000 shares at $12 per share. Prepare a journal entry to record the sale of stock for cash under each of these alternatives. The first is that the stock has a par value of $5. So let's look SE6. Under SE6, common stock, $5 is the par value, 5,000 shares at $5, 25,000 is going to be put into common stock, and the difference, the 5,000 shares times $7 a share, the above and beyond, is put into additional paid-in capital. And the cash is increasing $60,000. Okay? Now in number 2, all we're doing is changing it. There's no par value, but they have a stated value. It says here, the stock has no par value, but the stated value is $1 a share. Well, we're going to do it the same way. The cash, of course, is 60. Common stock is going to be 5,000 shares times $1 stated value, or $5,000 there. And then the additional paid-in capital is going to be the difference. The $11 a share times 5,000 shares, or $55,000 is going to be an additional paid-in capital. Does that make sense? Now, SE7. Tulip Corporation. Am I going too fast for you guys? Tell me to slow down if I am. Okay? Tulip Corporation issued 16,000 shares of its $1 par value common stock in exchange for land that had a fair market value of $100,000. Prepare the journal entries necessary to record the issuance of the stock for the land under each of these conditions. The stock was selling for $7 per share on the day of the transaction. Or number 2, management attempted to place a value on the common stock but couldn't do so. What's the first thing we know? What will we value that land at? Well, in number 1, if we know what the market value is of the stock, that's what we're going to value it at. So if it's going for $7 a share, and they issued 16,000 shares at $7 a share, we're going to show that land to be, is it 112,000? $112,000. So if we know the fair market value of the stock, that's the first way we're going to do it. So we would show land of 112, common stock would just be times the par value, and the excess is going to go in additional paid-in capital. Now number 2 is right if we don't know the fair market value of the stock, the fair value, then we're going to take what the value of the land is, as you see in number 2. Okay? Okay. Let's look at E6A. Gormanus Corporation was organized in 2014. It was authorized to issue 400,000 shares of no par common stock with a stated value of $5 per share and 80,000 shares of $100 par value, 6% non-cumulative preferred stock. On March 1st, the company issued 120,000 shares of its common stock for $15 per share and 16,000 shares of its preferred stock for $100 per share. We're going to use T accounts to record the issuance of the stock. Now, do we care about how much it was authorized to issue? No. On March 1st, the company issued 120,000 shares of its common stock for $15 per share and 16,000 shares of its preferred stock for $100 per share. So what is the cash going to be? What's the increase in cash? For the common stock, wouldn't it be 180? Or 1,800,000? No, 1,800,000? 120 times 15. And then for the preferred stock, 16,000 times 100 per share is what? 1,600,000? $1,800,000, $1,600,000. You see how our cash is increasing? Now, let's look and see what the common stock is going to look like. We've got the company issued 120,000 shares of its common stock for $15 per share, but the stated value is $5 a share. So 120 times $5 a share, or 600,000, is going to go, 600,000 here is going to go into the common stock. The difference between the 1,800,000 and the 600,000 is going to go into additional paid-in capital, isn't it? Okay? Now, as far as the preferred stock was 80,000 shares of preferred stock were authorized, but they issued 16,000 shares at $100 per share. The par value is $100 per share, so nothing's going to go into additional paid-in capital, is it? So as you see here, the 1,600,000, that exact amount is going to go over to the preferred stock because they sold the stock at par value. So there's no additional paid-in capital here. Okay? Now, prepare the stockholders' equity section of Gormanus' balance sheet as it would appear immediately after the company issued the common and preferred stock. So as you see, we always label everything, and we start with contributed capital. We always record the preferred stock first. So we show our preferred stock, $100 par value, 6% non-cumulative. We show 1,600,000. Common stock, $5 stated value, 400,000 shares authorized, and 120,000 shares issued and outstanding. The difference is going to be the additional paid-in capital. And we've got, as we total them all, our total contributed capital. How you guys doing? Let's look at E7A. E7A says Sussex is authorized to issue 100,000 shares of common stock. On August 1st, the company issued 5,000 shares at $25 a share. Prepare the journal entry to record the issuance of stock for cash under these alternatives. Number 1, the stock has a par value of $25. What are we going to do there? If we issued the shares for $25 a share and we're assuming the par value is $25, are we going to increase cash and then our preferred shares, it's going to be 5,000 times the $25, right? Number 2, the stock has a par value of $10 a share. Our cash is going to be the same amount, 5,000 shares at $25. But if the par value is only $10, we're only going to take the 5,000 shares times $10 and place that in common stock. And the difference is going to go into additional paid-in capital. Okay? Now, number 3, the stock has a stated value of $4 a share. Same thing. We're going to show excuse me, did I miss something? Number 3. The stock has no par value. Sorry. If the stock has no par value, it's all just going to go right into common stock. But in number 4, if it has a stated value of $4 a share, we're going to show the stated value in common stock. I thought am I screwing something up? Oh, $1 share. I'm looking at E8A. So we're going to show 5,000 shares at $1 per share is going to go into common stock, and then everything else is going to go into additional paid-in capital. Okay? Now, I want you to take 3 minutes and do E8A on your own. E8A says on July 1st, 2014, Jones Corporation issued 40,000 shares of its common stock to finance a corporate headquarters building. The building has a fair market value of $1,200,000 and a book value of $800,000. Because Jones is a new corporation, it's not possible to establish a market value for its common stock. Prepare journal entries to record the issuance of stock for the building, assuming the par value of the stock is $10 a share, the stock is no par stock, or the stock has a stated value of $4 a share. If we don't know the trading value of the stock, what will we use to record this transaction? Anybody? Please don't speak all at once. Remember, the first thing we'll use is the fair trading value of the stock. If we don't know it, we're going to use the fair market value of what we're receiving. Okay? Take a couple minutes. Let's look at what we're going to do here, guys. The first scenario is going to be the building of 1,200,000. Common stock is going to be 400,000 because the par value is $10 a share, and the additional paid in capital is 800,000. The number 2 scenario, since there's no par, the building is going to be 1,200,000 and the common stock is going to be 1,200,000. In number 3, if we have a $4 stated value, then the building again is 1,200,000. The common stock is 160,000, with all the difference going into additional paid in capital. Does that make sense, guys? Doesn't matter. The book value is really whatever the company had. Who knows how long they had it? Who knows the depreciation? So they're throwing you that to confuse you. I know, it doesn't take much to confuse me either. So don't feel bad about that. Okay, so let's move on and let's start talking about treasury stock. Now, what is treasury stock? It's the stock the company buys back that's out in the public. Treasury stock is stock the issuing company has reacquired, usually by purchasing shares on the open market. Why do they want to buy it back? Maybe they want to buy it back so they can give it out to employees. Maybe they want a favorable market for its stock, so they want to tighten up the shares outstanding. Maybe they want their earnings per share per stock to look better. So if they buy back some of the stock, there's less stock outstanding. Or maybe they want to have some shares so they can purchase other companies. Another thing, hostile takeovers get crazy. But if there's stock outstanding there, anybody can go up and buy it. So if you think about it, if someone's willing to come in and pay a lot of money for stock, people are going to sell their shares so they can get that money. So then you can have someone that's coming in and taking over your company. You don't want them to. So you always have to play a defensive role to make sure you keep a piece to yourself if you're able to financially do that. Here's an example. On September 15th, Kodak Corporation purchases 2,000 shares of its common stock on the market at a price of $50 a share. The entry to record this purchase is we're going to increase our treasury stock with a debit of 100,000, which is 2,000 shares at $50. We're going to decrease our cash with a credit of 100,000. In the stockholders' equity section of the balance sheet, we're going to show $100 is going to be $100,000 is going to be deducted from the total contributed capital. See how right now the contributed capital is $1,260,000? We're going to show less treasury stock of $100,000 to make our stockholders' equity section $2,060,000. So as you see here on a T account, our treasury stock is being debited. Our cash is getting credited. We're acquiring back stock. Now on November 15th, Kodak sold 2,000 shares of its $5 par value common stock on the market at a price of $50 per share. So we're basically now selling our treasury stock. So what's happening in this scenario, since we're selling that treasury stock that we have, we're going to increase our cash and we're going to decrease treasury stock. So you see here, cash gets increased, treasury stock gets decreased. On November 15th, Kovacs sold for $60 per share 1,000 of the treasury shares that it repurchased at $50 a share. So we're going to increase our cash. We're going to decrease our treasury stock. And then the difference is going to flow into paid-in capital. So as you see here, when treasury shares are sold for an amount greater than their cost, the excess of the sales price over the cost isn't a gain. It gets credited to paid-in capital. So as you see here, our cash increases $60,000. Then our treasury stock gets credited, and what we now call paid-in capital treasury stock gets credited. On December 15th, Kovacs sells its remaining $1,000 treasury shares for $38 a share. So this is now less than what we show in treasury stock. So we're going to, of course, increase our cash. We're going to decrease our paid-in capital. Now we decrease our treasury stock, and we also have to reduce our retained earnings. So look and see how we're doing here. The decrease in treasury stock common increases stockholders' equity. You don't record losses when you sell treasury stock at less than what you bought it back for. What we have to do to offset that difference is take our retained earnings, because we're having to use our retained earnings to offset that treasury stock. We bought it back at a higher price than what we're turning around and selling it for. So what are we going to do there? We can only bring our treasury stock to zero. Then we have to take some retained earnings to pay that difference. So as you see here, we received $38,000 in money. We had the paid-in capital treasury stock for $10,000. We have to clean out. We have $50,000 in our treasury stock common. But do you see how we have a deficit here? So to zero out our treasury stock of $50,000, and we're going to offset our paid-in capital, we then have to take it from retained earnings, okay, to zero it out. If the company decides not to reissue treasury stock, it can retire the stock. So on November 15th, Kovacs decides to retire 2,000 shares of the treasury stock. If the $5 par value stock was originally issued at $6, the journal entry to record this retirement, we reduce our common stock, we decrease our paid-in capital, we'll have to decrease our retained earnings, and decrease our treasury stock. Think of it kind of like declaring or paying dividends. You've got to take out of retained earnings to pay dividends. In the same respect, if we're retiring treasury stock, we've got to clear it by decreasing our retained earnings. Same concept as paying dividends. If a company decides not to reissue it, it retires it. So as you see here, we're zeroing out that common stock we're retiring. We're zeroing out that portion of the paid-in capital. we are zeroing out the Treasury stock. And in order to do that, we've got to offset our retained earnings. We're going to reduce our retained earnings by that amount of Treasury stock we're retiring. So let's do a problem. You guys will tell me when you need a break, won't you? Yes? Let's look at E9A. E9A. This is dealing with Treasury stock. Record Demio Corporation's stock transactions, which represent all the company's Treasury stock transactions during 2014. May 5th, we purchased 800 shares of its own $2 par value common stock for $20 per share, the current market price. What's going to happen to cash? Goes down how much? $20 times 800 shares? 160,000. Is that right? $16,000. I'm sorry. I was just off a zero. So 16,000. Okay? So our cash goes down or decreases 16,000 or is credited. What's going to happen to our Treasury stock? Our Treasury stock is debited, right? For 16,000. See on this T account here? May 5th, 16,000. Next, on May 17th, we sold 300 shares of Treasury stock purchased on May 5th for $22 per share. So what's going to happen to cash? Go up by $66,000. Thank you. 6,600. The amount of Treasury stock, 300 shares. 300 shares of Treasury stock. We purchased them for $20 a share, right? We're now selling them back for $22 a share. So what are we going to credit to Treasury stock? 20 times 300 shares? Or $6,000 here? Right? Then the difference, because we're selling it back to the public for more than what we bought it for. The difference goes into paid in capital Treasury stock for $600. Right? Then, next, we sold 200 shares of Treasury stock purchased on May 5th for $20 a share. Well, isn't that what we bought it for? So we're selling it for the same we bought it for. 200 shares at 20, $4,000. What happens to the cash? Goes up 4,000. What happens to the Treasury stock? Gets credited 4,000 bucks. Okay? Next, we sold the remaining 300 shares of Treasury stock purchased on May 5th for 19 bucks a share, less than what we bought it for. Okay? Now we need to zero out that Treasury stock, and we need to offset the difference into retained earnings, don't we? So we sold the remaining 300 shares for 19 bucks a share. Thank you. So we have $5,700 we received in cash. We need to show a credit to Treasury stock for $6,000. And basically, we're going to offset this, ultimately retained earnings, but we're going to debit this. Excuse what I told you. We're going to debit this paid in capital, 300 bucks. Okay? You guys cool with that? Now let's look at E10. E10, record Carmel Corporation's following stock transactions, which represent all its Treasury stock transactions during the year using T accounts. June 1st, June 10th, June 20th, and June 30th. I'm going to give you 5 minutes. I want you to try. Okay, now. What are we going to do here? What's the first thing we're going to do, guys? Perfect. So that is going to be a credit to cash, right? So our 1,000 times 70, we're going to credit 70,000 in cash. And what are we going to say as far as the Treasury stock? Debit of 70,000. Next, sold 250 shares of Treasury stock purchased on June 1st for 80 bucks a share. What are we going to do there, guys? What's our cash going to be? $20,000? 250 times 80, 20,000 even. What are we going to do with the Treasury stock? On June 10th, we purchased the Treasury stock for 70 bucks, didn't we? We sold it for 80. So we're going to credit the 250 shares times 70. And what are we going to do with the difference? Paid in capital, Treasury stock. Next, we sold 350 shares of the Treasury stock purchased on June 1st for 58 bucks a share. That's a bummer. We bought it for 70 bucks. We're selling it back now for 58 a share. What is our cash going to do? Debit cash of 350 times 58. $20,300. Our Treasury stock, we need to offset this by the number of shares, 350 shares. When we bought it back, it was at 70 bucks a share, right? So we need to offset that, 350 times 70 bucks a share. So we've got a balance we need to handle. We're going to handle that by debiting our paid-in capital for Treasury stock. Okay? Because remember, our Treasury stock, what we purchased it for, if we turn around and sell it for less than that, we need to at least zero out that Treasury stock and put the difference into paid-in capital. Next, we retired the remaining shares purchased on June 1st. So we purchased 1,000. We sold 250 and 350, which totals 600. So we've got 400 left. And we need to clean this up. We need to get rid of it out of Treasury stock. We need to get rid of the issued and outstanding out of our books, so we can tell the original price was $42 a share. So what are we going to have as our credit? We have to zero out our Treasury stock. So we have 400 shares that we are retiring. We bought those shares back at $70 a share, didn't we? So we need to at least go into our Treasury stock and credit $28,000 because we no longer have any Treasury stock on hand. So we need to zero that out, $28,000. The other thing we need to do is we need to get rid of the common stock sitting on the books. The common stock of 400 shares, we initially sold them at $42 a share. The par value is $30 a share. So we need to show a debit to common stock of 400 shares times $30, because remember, common stock only contains the par value. And then the difference is additional paid-in capital. So since we initially issued them at $42 a share, we know when we issued them, we credited common stock for $12,000, credited additional paid-in capital for $4,800. By retiring them, we need to do the opposite. We need to debit our common stock to get them out. We need to debit our additional paid-in capital of $4,800, right? And then the difference, the $28,000, that was our Treasury stock, minus the $12,000 par value, minus the $4,800 paid-in capital, the $11,200, when we retire them, that's then when we debit our retained earnings. Okay? We're not keeping them on our books anymore. We're getting rid of them. Let's look at another one. Okay, how about SE9? How about SE8? Have we done SE8 yet? No. SE8. SE8. SE8 says Prepare the journal entries necessary to record Dow Company's following stock transactions during 2014. We purchased 2,000 shares of its own $2 par value common stock for $20 per share. What are we going to do there? We debit treasury stock for how much? $40,000. What are we going to credit? Perfect, cash. October 17th, we sold 500 shares of treasury stock purchased on October 1st for $25 a share. What are we going to debit? Cash of how much? $12,500. What are we going to credit? We're going to credit treasury stock, 500 shares times $20 a share. What we purchased it for, didn't we? What else are we going to credit? Additional paid in capital treasury stock? Paid in capital treasury stock for $2,500. Now, we sold some more treasury stock, 800 shares. We sold 800 shares for $18 a share, but guys, what a bummer. When we bought them for $20 a share. What's going to happen? We need to still zero out our treasury stock. Since we bought it for $20, we need to credit our treasury stock for 800 shares times $20 a share, $16,000. We only received cash of $14,400. What happens to the difference? Goes in our paid in capital, doesn't it? Now we move on to the next portion. It says, refer to the information for Dow Company and SE8. On October 28th, Dow retired the remaining 700 shares. The shares were originally issued at $5 per share. What are we going to do here, guys? We've got to credit treasury stock, don't we? 700 shares times $20 a share, we've got to credit treasury stock, right? $14,000. Now, it tells us we originally issued them at $5 a share. So we've got 700 shares, but the par value is $2. So don't we need to zero out our common stock by debiting 700 shares times $2? 700 shares times $2. We got to debit common stock, $1,400. That additional $3 a share that we issued them for, 700 shares times $3, needs to debit additional paid in capital, so we can zero that out. We also need to clean up our paid in capital treasury stock. The difference is going to go into retained earnings. Okay? Now, we're going to talk about how we go about accounting for dividends. Sometimes board of directors don't declare dividends. Sometimes they need money or they're going to expand. Sometimes they want to liquidate debt. There's always reasons they may want to hold on to money. Apple has been notorious until recently, never ever issuing dividends when they have a lot of cash on hand. So there's reasons they don't pay dividends. However, when they declare dividends or pay dividends, we need to learn how to record them. We need to know about 3 dates: the declaration date, the record date, and the payment date. Now, the declaration date, this is when the board of directors says, hey, we're going to pay a dividend. At that time, when they say they're going to pay a dividend, a liability becomes evident. They usually say, hey, we're going to pay a dividend. We're going to pay a dividend for people who own stock on this date. That's the record date. The record date is the date on which ownership of stock is determined. People who own stock on that day get the dividend. If the owner on the date of record sells the shares of stock before the date of payment, the right to the dividend remains with that person. The payment date is the date the dividend gets paid. So let's talk about how we do this. On December 21st, the company declares a cash dividend of $28,000. At the time they declare the dividend, a liability exists. We increase the account called dividends. We increase the liability called dividends payable. So on December 21st, we debit dividends. We credit dividends payable, declaring dividends. Then the dividends account reduces equity by appearing as a deduction from retained earnings. Dividends come out of retained earnings. On December 31st, the record date for the dividends is declared on December 21st. So basically they're saying, hey, this is the record date. We don't have to do anything to show this is the record date, okay? But it's that date when people who own the stock at that time get the dividends. No journal entries made. Then the dividends get paid on January 11th. At that time, we're going to debit our dividends payable because we don't owe that liability anymore, and we credit our cash. When the date of declaration and the payment date occur in the same period, the amount of dividends shown in the statement of stockholders' equity and the statement of cash flows is equal. If a period ends between the date of declaration and the payment, then we have to adjust some accounts, which we'll look at. Okay, so let's take that and look at some problems here. Okay, so SE10. SE10. Leon Corporation has authorized 400,000 shares of $1 par value common stock, of which 320,000 are issued and 280,000 are outstanding. On May 15th, the board of directors declared a cash dividend of 20 cents per share, payable on June 15th to stockholders of record on June 1st. Prepare the entries using T accounts for each of the 3 dates. We know the day of record. We don't have to do a journal entry on that, do we? The day of declaration we do, and the payment date we do. So if they issued a cash dividend of 20 cents for 280,000 shares, right? So, what are we going to do there? Cash dividends. On June 15th, on May 15th, we show a debit to dividends of $56,000, a credit for dividends payable. On June 15th, we're going to pay them out by crediting our cash. We no longer have that liability. We debit our liability for $56,000. Right? Let's look at P3. You guys want to do P3? Are you guys getting tired? How is everyone doing? Are you exhausted? How about, let's do this, guys. How about for next week, you do P1, P2, and you should be able to do P3. Then when you come back, actually, you should be able to do P4 and P5. Because I'm not going to get into declaring stock dividends, but P1, 2, 3, 4, and 5 don't have anything to do with stock dividends. So I think the key that I did not cover is when stock dividends get declared, not cash dividends. But I'm not going to worry about that right now. We've absorbed a lot. Okay? So homework, P1, 2,